Today, we got a huge news to share with you. A $71 million deal we recently closed on when we raised over $33 million for it. A 312 unit Class A property built in 2016 located in Houston, Texas. In 4 years, we have gone full cycle, aka sold our apartment complexes with an average of 2.3x equity in 23 months and a half.
One of them, we delivered a 3.11x equity multiple within 27 months, short period of time.
You'll hear about apartment syndicators that have sold properties, but very few of them share their track record and lesson learned.
Today, we're going to be dedicating this entire episode to help you go through all the lessons that we learned that led up to the $71 million moment for all of us.
There are plenty for sure, guys.
Of course, and that's why, again, we can't keep these lessons to ourselves. So that's why this episode is so important, to cover all the little and big lessons that we learned that led up to this moment. We definitely didn't do this by ourselves, and even more importantly, this opportunity is available for anyone who's ready to live their best financial life.
Are you ready?
Let's get started.
You know what they say, you can't move into the future without honoring the past. So let's remember our humble beginning in apartment syndication.
Yes, so cash flow multipliers, prior to this deal, our biggest deal to date was a $40.5 million property that we purchased in Atlanta, Georgia. We closed on this property earlier this year in February of 2022, just a few short months ago.
2022 has been a wild one. Agree or disagree, Palm?
Agree.
Yes, absolutely, right? Well, first, a $40.5 million deal, now a $71 million deal.
Good one that we got this one at a discount. Whether you're new to apartment investing or a seasoned investor, we think this is going to be a really rich conversation, and we're so excited to dive right in.
Yes, I'm so excited. So let's get going, guys.
So the first lesson learned right out of the gate is that when an investment opportunity comes knocking, with the right team, the right opportunity will still remain the right opportunity, no matter what time of year it is.
This is especially true for our latest win, the $71 million deal, right?
Of course, Nan, you cannot be more accurate. You see, we're living in a period of high inflationary and where the interest rate is hiking. It's that the people still fail to realize that if you have a conservative and solid underwriting and a simple and sound business plan, you can make the most out of any investment situation and opportunity. This is what really happened to us and our $33 million plus that we were able to raise for this property.
During the thick of the deal, a $33 million raise for a $71 million deal's asset sounds like a big deal, and it was, right? However, in a normal scenario where the LTC is around 80%, how big of a deal would it be?
Let's do a quick math. If the LTC was around 80%, this means that we would have bought a $165 to $66 million property.
One word. Wow, right? So Palm, can you explain here, what does lower LTC, loan to cost, mean?
With the lower LTC, means that lower risk, which translates therefore to more cash flow to pay down the monthly mortgage, and this is just lesson number one.
Next, if you've been listening for a while, then you know we have nothing but hard eyes for Class A apartment. We started in Class C, where a lot of working class families live, and we have nothing but aim upwards when it comes to moving up to the next class.
I'm so glad that we had our eyes set on A-class assets from the beginning, because this became a proven investment strategy in the long run for us and our $71 million property. Not only because it's a newer asset, but also because of the stronger NOI growth potential in Class A apartments have also less deferred maintenance on the property. And of course, it also has multiple exit strategies that we definitely would want to utilize.
Yeah, so I love what you just said, Palm, and especially during these volatile times, the capital markets are not lending on Class C and certain Class B asset. For lenders, they are looking all at those asset class to be a little too risky for what they're willing to lend out right now.
However, with Class A apartments in the strong submarket, similar to the one we had in our area, what this means is that it has strong population, strong job opportunities, rent growth obviously, absorption rates, limited construction pipelines, all of which means that there's potential for us to increase rental income organically without even having to break out a hammer or a paintbrush.
I was going to say that.
Just look at the surroundings and do your research on your own, guys. You can see the location and the potential super simply. And during this time, we had the property under contract. The property income actually continued to strong uptrend. And what this means is that we were able to continue to see 14% rent increases on returns.
The next lesson we we learned is to never underestimate the power of relationship. Relationship all over the spectrum of human experience we call life can make or break us. Cue any love song you have ever heard.
But the reason for these powerful emotions definitely transcends even a romantic relationship. Think about friends, family, co-workers, and your business partners. Like the story that we're about to share, all play a significant role in our lives. To not nurture the relationship in your life will cost you. And in our case, the price will be almost $71 million.
Ouch, right? For our little story time during these unprecedented time, our lender, Arbor, decided to cut its lending budget from $1 billion to just $300 million monthly. It was definitely a conservative approach, but we had already done 5 loan transactions with Arbor, so the proof was in the pudding. They know we were good for what we borrow.
And this played out in a major way on our $71 million deal. Arbor worked with us and did everything shy of breaking their own backs to cut down their commissions to lend to us so that it makes sense for us to close with them. On top of that, they actually declined a loan from 2 family offices that had over $60 million in the bank, cold in the bank, in a prime location in Jacksonville, Florida, so that they made sure that they can reallocate enough capital for us to close on our deal.
Why? Because relationship matters. It's more than paying back what we owe. We were intentional with the lenders we choose because we knew we would work closely with these people. Every phone call, every email, meeting wasn't just business for us. We view Arbor as an extension of our team and treated them as such.
Relationships matter to them. Execution certainty matters to them. And if there's only one thing they knew that the Kitti sister could do, it's that we can execute. Due to our track record, they never asked us to even provide a proof of fund that we had the $33+ million in the bank account ready to be deployed to close the deal. That's the power of relationship.
The next lesson that came to us through this process of $71 million deal is that leadership is needed. From the very first webinar to the very last signature, this investment opportunity could have gone sideways 8 times over. Everything was at risk, right, Palm? From the interest rate hike to raising the necessary equity needed to complete the raise to the Docusign malfunction the day that we opened our subscription doors.
I can still feel the pain from that day. Yes, that happened. And yes, we were in full panic mode.
Oh my gosh, that was totally nerve-wracking moment for sure.
You really have to do a multi-family apartment investing like a team sport. We all been there, right? No doubt, we have one of the best teams in the game, but the truth is when it comes down to it, I think being a lead general partner of an apartment syndication deal really means that you're the one who has to step up to be able to step up and help your team when they need it.
Yes, and that call can happen at any time, right? We had to step up when it became evident that they were raising gap that our article GP partners couldn't fill.
Nan, I remember that lesson being super valuable for us, and it's something that we'll definitely take on to future projects, right?
Yes, all along we were underestimating ourselves. We thought we could only raise X amount, but we ended up raising 2 times the amount.
The truth be told, we surprised ourselves as well. The lesson here is that when you build your reputation of being a solid lead sponsor who work hard and make serious money for your passive investors, it shows in return because they're gonna be coming back and investing with you.
Due to our extensive asset management, we have negotiated terms with our property management team in the past, and the same is true with our current deal, right? While we work with the best team, that doesn't mean we cut corners. We always verify work because we have a legal and ethical standard to maintain for our passive investors.
Our fiduciary duty, that is. On this particular property, the property management team came back to us and they proposed $1,800 was going to be what they're going to pay the staff for the building, which is a lot higher than our original budgeted amount, which was $1,600 per unit per month. Something about the numbers felt a little off to us and seems a bit high, so we pushed back on the property management team and asked them to mathematically justify that $1,800 per door amount. We previously budgeted to have 1 maintenance lead and 2 assistants, so there was no need to hire any extra part-timers. There clearly has to be some room of negotiation that we had to do, and we got it done.
And we did it, right? The property management team is willing to work with us, and we were able to push down the cost. Now, this deal has the original closing date of June 14, but nope, we couldn't close until July 15. To be fair, it's typical to have some delays.
Yes, being transparent with our passive investors and letting them know along the entire way the new closing timeline is very, very important to us. And through all of that, more lender delays, we officially, like Nan said, closed on July 15th, but we never let our investors get out of the loop. The trust factor is everything with us. Moving on, retrading was never a term that we really want to use at all. While other sponsors at that time asked for retrades as aka discount as like a status quo thing because everyone was doing it, we never wanted to get to that point with our team because we didn't want to put our reputation on the line.
Yes, but when we got the call from the lender, they adjusted our LTC and we had no choice but to call the seller and negotiate a retrade. And here's where things took a turn. In negotiating the retrade, we were able to get $3 million discount from the seller. This means we purchased a $78 million appraised value property for $68 million, achieving a $10 million built-in equity from day one.
Actually, technically, even before we closed, the property already went up by 10 million, right? Essentially 30% increase in that equity buildup. While the sellers were working with us, he's also great to work with, but he was also a businessman. For him to give us a $3 million discount, he was expecting something in return. And so he asked us to drop another $1 to $2 million in additional non-refundable earnest deposit on top of the $1 million non-refundable earnest deposit we already sent him on day one of the contract.
We look at the $1 or $2 million additional deposit and deem it too risky for our investor because if the deal goes south, we would not be losing that $1 million that we already wired, but the additional $1 or $2 million earnest deposit. So instead of going with the seller flow, we hatched our own plans and gave reasons why we would kindly decline his request.
At the end of the day, sometimes it's just really just business and there's nothing personal about it. Obviously, the seller wasn't too happy with our latest request at the time, but we knew that his motivation was, we knew what he wanted to get out of this, and that is that he wanted to close this deal ASAP and secure, as the kids say, the bag. The other trick up our sleeve was that we knew that had the seller brought the property back onto the market right at that time, he probably wouldn't have been able to sell the property at all due to the volatile conditions in the capital market.
This brings us here today, happy to report that instead of an additional $1 to $2 million hard-earned deposit, it was only $290,000 that we wired for him. Plus, we cut in a 14 days extension just in case we needed it.
We didn't really actually use it yet, but we needed it anyway, just as insurance, right? Remember, everything is completely negotiable. Knowing the motives, play to your advantage, and definitely don't underestimate the power that you can go toe-to-toe with a seller and negotiate the terms that will benefit your investors.
Our next lesson has to do with knowing and choosing the right strategy. So the first right strategy is private equity versus raising private capital. Choosing the right capital stack is important, guys. You know that. We choose not to go through with a PE, though we were approached with a few options, meaning we raised way more money. However, during this volatile time, the deal would have evaporated anyways because some of the PE shops were shutting down. Instead, we went with a tried and true method we know will close, and that is raising capital from our incredible team.
Secondly, you know the phrase, save your money for a rainy day? Well, that similar rule definitely applies to multifamily apartments. Having a hefty reserve for an unforeseen day, being really healthy, means that there's no capital cost.
Our third strategy is to plan for the worst and hope for the best. We perform a lot of stress tests in the worst case scenarios. It's the only responsible things to do. Palm is our data cookie cruncher here, so on this deal, we perform several sensitivity or stress tests that we specifically design and also think about, hey, how is the increased interest rate will do.
So speaking of interest rate stress tests, here, even as the interest rate increases, it's gonna barely impact the overall return on the property. So for example, if the interest rate hits 6%, the property will still return close to the original projection in 5 years' time. This is definitely helps reassure our investors that the doom and gloom news that they're hearing on a regular basis isn't true. Turns out it's nothing more than their scare tactic that people use in order to get them glued to their screens or their TV.
Our concluding lesson about a $71 million deal is to have a strong squad. You want an A players for those A grade assets. And we had Arbor as our lender who slashed their commission to work with us, and of course a strong property management team who work with our budget. We also have our law team expedited and revised PSA in a few hours, which is completely unheard of.
Having a strong squad, building on those relationships, and having the trust at the center will get you further than you can imagine. The African proverb, if you want want to go fast, go alone. But if you want to go far, go together is so true in this case.
2 days before our planned closing date, the seller decided he was not ready to close, although our internal lending team deadline was July 13, or else the lender couldn't close the deal for us. Cash flow empires, as you can imagine, this caused some commotions, but we had the ultimate secret weapon to get us through.
Yes, an incredible Hogwarts squad that can rival any Death Eaters.
Okay, Palm, this is so Potter out.
Yes, it is. But no apologies. Or in this case, the lender that allowed us to fund on the 14th and close the deal on the 15th. Cue the huge sigh of relief, champagne popping, celebration, and a booking of the well-deserved vacay to clear our minds and reset for the next deal that you know is going to be around the corner.
To say we've been through a lot this summer is an understatement. Boy, are we thankful for our passive investors and our incredible team who have, been through with us so much.
The right strategy, mindset, and tapping into your own power have paid off big time, and we know there's more to come with this and other lessons that we've learned. So that's it for this week, guys. If you like this, please click the subscribe and bell icon.